All right, good Wednesday morning, investors and traders around the world. Welcome back to Finom Group's latest video. This week we'll take a look at some updated and reviewable quantitative data. We'll take a look at some technical analysis, and we'll look at some fundamentals as well. We're through the earnings season, so how did that shape up? So a nice update here as we travel through the Q2 2024 trading season. Now that we are out of the earnings portion, we're heading into June. What does June have in store for investors and traders? Let's find out. So you probably heard this colloquialism in the past, and if you don't know anything about your host, Seth Golden, you know that I'm not a big fan of colloquialisms, especially those that are thrown about Wall Street. Nonetheless, no pain, no gain. Now, most Wall Street colloquialisms are not true, and this one obviously did not generate on Wall Street, but it is a pertinent colloquialism, maybe for what we're heading into the month of June. No pain, no gain. Folks, if you're an investor, if you're a trader, there's going to be pain. You're going to suffer ups and downs. The best traders and investors that I know suffer those ups and downs well. And how do they do so? Due diligence. They're training, right? No pain, no gain. Shut up and train. So let's train our minds, and let's see if I can spark a little interest here in this week's video. With that, Wall Street colloquialisms are rarely justified by data or proven a valid consideration. Sell in May and go away. We've all heard of that. The reality is the sell in May and go away is mostly a correction or a pullback warning. Since 2000, here are the corrections and pullbacks per year that started around May and their respective duration. The average correction since 2000 is 9.5%. Some of them started before May. You've got some here in April. A lot of them started in May. There can be no correction or pullback as well. That only happened one time in 2014. But that's the reality of the sell in May and go away colloquialism that we've all heard. To the point it's quite trite. But again, the reality is you don't want to sell in May and go away. If you do get that average pullback, you want to be a buyer, especially in a presidential election year, especially if we'll get to the other ifs. All right, here's this was before we got into May. Bank of America Research issued this note highlighting that in presidential election years, the reality is from June to August, the market is actually up 75% of years. 75% of presidential election years, the market has delivered a positive return from June through August. So maybe you sold in May and didn't come back from June and August, you would have missed out. The average return is also 7.3%. It's a lot to miss out on. And folks, you miss out on that. I mean, that's the definition of opportunity cost, right? You're trying to time pullbacks because generally there is a pullback around the month of March. I'm sorry, the month of May. Do you really think you're going to time it precisely and get back in to capture all of this potential upside, 7.3%? Maybe you're a unicorn. I don't know. But that's not the way I would be playing things. I would be begging for a pullback so that I could add exposure to take advantage of the June through August period in a presidential election year. This calendar year, 2024, we're up 11.2, 11.3% through the first 100 days of the calendar year. That's the second best first 100 days for the S&P 500 in an election year. 1928, 12.5%. 1976, the gain through first 100 trading days was 10.3%. We were up more than 11%. So this is the second best first 100-day performance during an election year. What's even more interesting about this, the rest of the year returns simply if you were positive through the first 100 days, just being positive. Positive return in the S&P 500 through the first 100 days in an election year. The rest of the year returns, the percent of the time the market has delivered a positive return the rest of the year, 93%. Only one time did the market deliver a negative return in an election year, and that was right there. You have to go all the way back to 1948 recession. Election year, S&P 500 delivers a positive return the first 100 days, 93% positivity rate. That means only 7% of the time the market delivered a negative return the rest of the year. How do you want to place your bets, folks? You want to lean into the more probable outcome or the least probable outcome? And that's what quantitative data is about. It helps you to stack the deck in your favor. Lean into the highest probable outcomes. Here's the if. What about June? Let's just talk about June. Even when you've had a down April, which we had a 5-month winning streak from November to March of this year. Then we had a negative April return. Now we've got a positive May return. Even a down April, but May is good. When you've had a positive first quarter, June is even better. So here's the criteria, and this is from Fundstrat. Years when the S&P 500 delivers a positive Q1 and a negative April, May is good. But they say June is even better. Folks, this is an election year, and it's a bull market. Now, so let's look at June when we are in a bull market or X bear market. And here's the data on that. At the very bottom of this Fundstrat quantitative data set, X bears, that's only 11 occurrences, N equals 11, 11 occurrences. June, here's the June column, 100% positivity rate, meaning that June was positive every single time when Q1 delivered a positive return and April was negative in a bull market. See these negative ones here, 1981, 1937, 1930, bear markets. You're not in a bear market every other time it's been positive for the month of June. This is one that you want to remember. Oh, well, this will probably be the first time. You know, there's so many unprecedented circumstances, blah, blah, blah. There's always unprecedented circumstances. This time is always different. Another one of those Wall Street colloquialisms that people don't, they're afraid of saying it. It's a jinx if you say this time is different. The reality is it's different every time. Have we had another 9/11 deliver a recession? Have we had another great financial crisis deliver another recession? Are we going to have another pandemic recession? It's different every single time. That's just the reality. As I said atop this video, most Wall Street colloquialisms are not valid. We just get used to saying them, even though they have no practicality in what we're doing as investors and traders. Here's our reminder. We were up 5 straight months, November through March. Why are we reminding ourselves of this now? Same reason that we're trying to stack the deck in our favor with the data. After 5 straight up months, only once did the market deliver a negative return 9 months later. At that 5-month mark, and why I highlighted this column, at that 5-month mark, 9 months later, so the end of March, 9 months later, would bring us through the end of the year. The positivity rate or win rate, 97% of the time. After a 5-month win streak, 9 months later, the market delivers a positive return. Again, the only negative return, 2018. How do you want to, how do you want to use this data? How do you want to place your bets? Do you want to lean into the 3% probability or the 97% probability? Here's the other thing to recognize. Okay, so what was the price of the S&P 500 at the end of this 5-month win streak? I'm going to get you done, folks. I got you. 52.54. We're just above 5,300 right now. So what does that tell you? If at any point we drop below 52.54, which, between now and the end of the year is a pretty good probability, what do you do? This data tells you what you should do. You should be buying that dip because there's a 97% probability that by the end of the year, the market is above 52.54. This is practical, useful information. Also tells you, by the way, now we've only got, 6 months, 7 months, the end of the year. There's not a lot of time for down in this market. There's not a lot of time. 6-week win streaks, folks. Last weekend, barely by just a couple of points in the S&P 500, we completed a 5-week win streak. Can we make it 6 weeks? It's rare. In fact, the last time that we had a 6-week win streak, we rallied 9 straight weeks. We do have, before that occurrence, we had to go all the way back to pre-COVID, 2019. So we'll see if we get that 6-week win streak here. What this does tell you also, because this one ended right as the new year began, that 9-week win streak ended as the new year began. Then we were down 2 weeks in a row, and then we'd rallied through the end of January. Is that the bull market is strong. You're not getting a lot of downtime. Think about April, down 3 straight weeks, then all of a sudden rallied into May and making new all-time highs. We had a 5% pullback, then we rallied 6.5%. Not a lot of downtime. Take advantage. Staying overbought. I hear it all the time. We're overbought. We're due for a major correction. The market's going to crash. Markets don't crash from overbought conditions. They correct. They pull back from overbought conditions. They don't crash from overbought conditions without some kind of exogenous event. Markets crash from oversold conditions. You get oversold, and then people just give up, then the market just craters. Nonetheless, this also from Bank of America. In years when monthly Williams percent R was overbought, and that's a stochastic, was overbought from January through December, so a calendar year, the S&P 500 is up 100% of the time with average and median returns of 19%. Overbought conditions that persist deliver above average annual returns, folks. And so far this year, we've spent the first 5 calendar months of the year in overbought territory based on the Williams percent R. Here's the other thing that I found. When you look at the biggest corrections of these overbought years, 10.8% was the biggest correction. Now, I've gone on record before, you may have heard me say that I don't believe the stars are aligned for a full textbook 10% correction. We'll see what develops, but this also suggests that there's a very low probability of a 10% correction when you have this kind of overbought conditions. Most of the corrections are just pullbacks. They're less than 10%. All right, we drop below 12 for the first time in the post-pandemic period. We drop below 12 on the VIX. Market's too complacent. You hear that? The VIX can't stay here, blah, blah, blah. Is this something to worry about that we've gone from 19 in the VIX, because we did have a spike recently and during the month of April where we had that pullback in the markets. We got above 19 and then dropped back below. Historically, a couple of weeks ago, the volatility index dipped below 12, signaling decreased anxiety amongst investors. A low VIX generally indicates a market environment where investors expect less volatility and feel more confident. The last instance when the VIX fell below 12 after rising to 19 or better, resembling the recent occurrence, was in November 2019, which led to a 4.6% increase in the S&P 500 over the ensuing 2 months. Although a compression in volatility like now can lead to a short-term consolidation in stocks, it's typically nothing more than a pause that refreshes a bullish trend. A year later, after this criterion falls below 12 after getting above 19, a year later, the S&P 500 was higher 93% of the time. Some consolidation near term, normal and to be expected. Not all technical analysis is created equally. Over the weekend, I had posted out on Twitter or X that we had a Hindenburg omen, the first one since, I guess that's January, February of this year. This is the NYSE Hindenburg omen. Now, in and of itself, I know it sounds like a bad omen, but in and of itself, one Hindenburg omen is nothing to be alarmed about. It's when you get clusters within a 30-day period that they can prove more, you can have more adverse price action. They can signal a correction of sorts on the horizon, if not already taking place. So again, just one Hindenburg omen, nothing to be worried about, but you probably want to monitor for additional Hindenburg omens over the coming 30-day period. And by the way, the NASDAQ also finished last week, Friday, with another Hindenburg omen. The NASDAQ has had a much less healthy, or I guess you could say it's a split market with the NASDAQ through this bullish cycle. The high-low logic index got to its highest level ever. What's the high-low logic index, Seth? Well, that's basically is tracking the number of stocks making new 52-week highs in the index, the same time that they're other stocks are making 52-week lows. In order for the high-low logic index to make a new all-time high, it's telling you the NASDAQ is a very split index right now. And you can imagine the NASDAQ is a growth index. But some of that growth in there are smaller cap stocks, unprofitable tech, biotech, and they're just not working. They're making 52-week lows, and a lot of stocks that are mid and large cap within the NASDAQ are making 52-week highs. But a lot of folks will indicate to you that it's a very unhealthy situation in the NASDAQ. Now, in the past, when you've had the NASDAQ get to as high as it has in the high-low logic index, indeed, it has signaled very bad things for the NASDAQ, and it's happened in the S&P 500 as well, were on the horizon and eventually came to fruition. What I would argue is that this situation is very unprecedented, where we've had, if you think about small caps, even within the NASDAQ, right, small caps are the laggard, right? Whether it's the Russell 2000, small caps within the S&P 500, small caps in the NASDAQ. They're the laggards across the board, across the indices. Why? Rates are staying high for longer, folks. And that's, putting some anxiety amongst investors who know that a lot of these small cap, unprofitable companies carry a lot of debt, and that debt impacts their fiscal performance, their financials. So they're staying away from small caps, at least to a certain degree. And that's producing these unhealthy conditions within the NASDAQ. All right, moving on. I saw this chart and it kind of caught my attention. I guess that's last Thursday or Friday from the Heisenberg. And I want to highlight this because there are some things that need greater context and your ability to pay attention to what's going on here. I guess that's the best way to put it. He's looking at these divergences. He's looking at these trend lines. The mother of all, the baby of all trend lines. And then here's the mother of all trend lines. And then you've got, they don't call it a bearish divergence for no reason, looking at the 14-day RSI, while the S&P 500 is making higher highs, new all-time highs. You've got this bearish or negative divergence going on here. And he's basically calling for a correction or a pullback of sorts. That was just last week. He did this before in February, and yep, he did it in March as well, folks. Right? If you know your recent history, no pullback of consideration in February, no pullback of consideration in March. Here we are in May making this similar type of pullback call based on what he's recognizing in the charts. Now, here's the thing that I don't have the greatest appreciation for. We're using a 14-day RSI on a quarterly chart, right? This is the quarterly performance of the S&P 500, since, what is that, 2008. But we're using a 14-day RSI. I would suggest use the daily RSI. If you're using a 14-day RSI, use a daily S&P 500 chart or a weekly RSI, weekly S&P 500 chart. Using a quarterly, you're going to miss out on something very, very crucial here, folks. Again, calling for pullbacks periodically as if it's just repetitious. You're not really matching your stochastic time frames with your index time frames. In my opinion, it's going to leave you without the appropriate context. So here's the same consideration. I got my 14-day RSI chart, stochastic on the bottom, and it's showing the divergence that he's pointing to. Right? We're not, we're not skewing anything here. I'm using a daily chart of the S&P 500. Why? This is what I mean by you're going to miss something. If you use the 14-day RSI on a quarterly S&P 500 chart, you're going to miss a lesson. And the lesson is you've had this divergence, this bearish or negative divergence in the RSI ever since December when the RSI peaked above 80. It's been downtrending. While the S&P 500 has been doing what? Uptrending, right? Imagine if you heeded some kind of bearish divergence or pullback warning from the social media elite out there. by selling your stocks or your index ETFs, you would have missed out on this run from 47.75 to 5,300. That's a typo. It should say 5,300. You would have missed out on this run. No, I would have recognized. Yeah, sure you would have. Sure you would have gotten back in. Sure. I'm sure you would have. Let's not kid ourselves. But this is what I mean, right? This chart just doesn't, when you have a quarterly chart, it doesn't allow you to see. This looks like it's happening right now. But the divergence, when you use a daily chart, has been happening since December of last year, to the tune of 12+% returns from 47.75 to 5,300 plus. You want to talk about opportunity cost? Most people don't, because they know they fall prey to this kind of stuff. When you get, this is the good overbought conditions. Overbought is good. Get it out of your head that overbought is a bad thing. You're doing it wrong. Moving on. And everybody's a market timer, right? This guy here, Milton Berg, February 7th. You know, we are eliminating long exposure. I believe that we're in a period of consolidation, correction, or perhaps at the precipice of a bear market, February 7th of this year. Opportunity cost. Brian Shannon, markets are below the declining 5-day moving average, which means caution, don't buy the dip. February 20th, opportunity cost. Opportunity cost is real and unquantifiable, other than by the accompanied regret. Wouldn't you have regretted not buying any of the dips, even if they were 1% along this way? I've also heard a lot about, well, it's just a handful of tech stocks leading the market, let alone leading tech. On an absolute basis, the technology, equal weighted technology sector ETF is at an all-time high. Not just a couple technology stocks, but if you equal weight every technology stock, you're still at an all-time high. The funny thing is, this is the chart you likely see out there. It's the equal weight versus the cap weighted technology ETF. Looks very different than the equal weight ETF on just an absolute basis versus a performance ratio basis. When you see this and then you look at this, the one thing that should come to your mind is, good Lord, if equal weight is at an all-time high and the cap weight is making the performance ratio look like this, that's how strong certain number of the cap weighted stocks are. It's not because there's just a few stocks, it's just that there are a certain few that are just remarkably strong. Nvidia, Broadcom, Apple, Microsoft, to name a few. Next chart, small caps, as we just touched on them a moment ago. Here's the good news, because I know there's a lot of frustrated folks out there. When are small caps gonna break out? Whenever. Shut up. Don't do that to yourself. If you're frustrated, you're doing it to yourself. And you're failing to recognize that it might just be a matter of time. Here in 2022's bear market, that's the middle here, 2022 to 2023, we spent almost the entire time, small cap has spent almost the entire time below the 200-day moving average. The 200-day moving average is sloping downward. 2023 fits and starts, spending some time below, spending some time above, but nothing terribly consistent. And we couldn't break out of this box until December of last year. Now, even though we're not launching, even though the breakout has been weak, we have an upward sloping 200-day moving average, and all of the price action has been above the 200-day moving average, basically for the first time in 3 calendar years. This tells you to stay bullish. It doesn't predict the future. It's telling you the conditions that have developed and are present today. And those conditions basically suggest that investors should remain bullish and buy dips should dips arrive in small caps. The economy, the household balance sheet, strong and strengthening. Folks, the total assets for household balance sheets in the United States, $176 trillion. Way down here are the total liabilities. Stop telling me the consumer is strained. They're stretched. They're under stress. Stop it. When you have house prices at all-time highs, when you have the stock market at all-time highs, these are real assets. You have demand. Somebody said to me the other day, yeah, but that's not liquid. Demand deposits are. That's checking and savings and money market accounts. Those are liquid assets. Guess what? All-time highs. Stop it. Stop it with the consumers weakening, the consumer stress, strained, blah, blah, blah. Personal bankruptcy filing rates are hovering over multi-decade lows. Have they turned up? Absolutely. Off of stupid low levels. I mean, stop with the consumers under stress and bankruptcies and oh my gosh. What guides the market? Earnings. Earnings were expected to come in. That was, March 31st, heading into earnings season, 3.4%. At the end of earnings season, 6.0% Q1 2024 earnings growth. Folks, what do you think is going to happen in Q2? Is the economy going to weaken? Absolutely. It should. The economy is not going to grow at 3% and 4% in perpetuity. But a growth slowdown is not a weak economy. The laws of large numbers have caught up with us. We're still going to be slowing to a healthy pace, maybe healthier, subdued inflation rates. Continued strong earnings growth points to higher CapEx spending ahead. This is from Torsten Slok. This economy is not slowing down. Earnings growth is a 3-quarter leading indicator for CapEx spending, and the continued strength in earnings suggests that we will see a strong rebound in business fixed investment over the coming quarters. Last but not least, higher for longer. I said earlier, the Fed has said, individual Fed presidents continue to say, this is the longest bond bear market in the modern era, or since the 1980s, the 1970s, in fact. People are getting frustrated. The same way they're getting frustrated with small caps, they're getting frustrated with bond market. TLT is a favored instrument. If you want to trade bonds, if you want to own, a bond ETF, right? And that's on a continued downtrend. It's in a bear market still, just like the bond market. This will make 46 months. At the end of May will be 46 months, the duration of this bond bear market. Don't become prisoner of the moment, folks. The best returns come from bear markets. You just don't know it in the moment. So don't become prisoner of the moment. Imagine if you could go back in time and buy the 2009 S&P 500 bottom at 666. Imagine if you could have bought. You're getting that opportunity with the bond market. The headlines are trying to sway you otherwise, the same way they did back in 2009. Don't become prisoner of the moment. Hope you enjoyed this week's video. And if you don't get our weekly research reports, if you want access to this data at your fingertips, it's on site at finomgroup.com. Subscribe. You'll have access to it every week. You'll get our access to our trading room, our trade and investment ideas, all the data backdated all the way, everything that we've published since 2017. Take care, everybody. Have a great trading week.